address this exact issue. If I counter, so let's say Diane's the applicant and she applies for 100,000 and I come back and say, you know what, I think we're only going to be able to do 80. Does that mean I have to give her a loan estimate for the 80,000 within 3 days of me counter offering? Or do I wait until she says that she wants to move forward with the $80,000 counter offer? And the TRID rules have an example in there that states that we can wait until Diane says she wants to move forward with the alternative option as it relates to her request, that counter offer. So that's the TRID side of it.
Okay, this one is along those same lines. If someone applies for a loan amount of $100,000, but we need to lower that amount due to the appraisal coming in lower than expected, can we consider this a changed circumstance and proceed, or do we need to issue a counteroffer and wait for the applicant to accept it?
Okay. Well, I do want to remind you, don't forget about the Reg B side of it, that if they don't accept the lower offer, you owe them a piece of paper, whether it's the counteroffer denial or a straight up denial because you couldn't do what they originally asked. So that's the Reg B side. On the TRID side, you may not have to provide a revised loan estimate in this changed circumstance situation if we're simply going from a $100,000 request down to an $80,000 request and there's no fee increases. There really would be no reason to have to provide a revised loan estimate. So in my opinion, in most cases, you wouldn't have to. Now, if there's a new fee or something else changes, then you would. But that's the answer to that.
If a borrower refinances rental property with cash back to purchase a new primary dwelling, do we report the HMDA purpose as a home purchase and that the loan is not primarily for a business or commercial purpose?
Okay, so first question, we got a dwelling secured loan to purchase a dwelling. That is a home purchase, right? And then second, I don't care what the collateral is a rental. This is to purchase a primary dwelling. So it's consumer purpose. So correct, not primarily for business or commercial purpose. That's correct.
Are we okay to use the paid by others column to give a tolerance cure if that means those amounts will not be included in the total of payments?
The answer, it's really short to this one, is yes, you can do that.
If a borrower refinances a primary dwelling with cash back to purchase an additional rental property, do we report the HMDA purpose as a home purchase and that the loan is primarily for a business or commercial purpose?
So just kind of the opposite of what we just had before with me. So yes and yes, that's a home purchase. They're purchasing a rental property dwelling, secured by a dwelling. And then second, this is rental property. So that would be business commercial purpose.
We do construction loans that are routinely refinanced into permanent financing. Is it okay to charge another lender fee on the refinanced loan if no additional money is dispersed?
I'm not aware of anything that would not allow you to charge an origination charge on the construction loan, another one on the permanent loan. Here's what I'm going to challenge you with is you got to be consistent. And that's not a TRID thing. That's going to be a fair lending thing. So consistency is what we're going to want there. We don't want to be charging here, not charging there. Make sure you're consistent across the board. Now, one thing that is in TRID is you have to, when it comes to points and fees, and charges like that, you need to make sure that they're charged relative to the side of the transaction to which they pertain. In other words, don't charge permanent fees on the construction side. Don't charge construction fees on the permanent side of the transaction.
We write fixed rate qualified mortgages with a 7-year balloon. We will renew that mortgage for another 7 years. Most of our mortgages are amortized for 14 or 21 years and some for 28. According to Regulation Z 1026.20A, as long as the existing note is satisfied, we can set the renewal rate at the current rate, even if it is higher. We renew the flood determination and have them sign a modification to the existing note at renewal, but don't provide any other disclosures. Are you aware of any changes to this in the future?
All right. I'm glad this was a pre-submitted question. I reviewed. Jared and I discussed, Diane and I discussed this. There's quite a bit on the table here, and I'm going to take a few minutes. This isn't just a short answer. Whoever asked this question, we've got some interchangeable wording going on. Sometimes you're talking about extending the loan or modifying it. Sometimes you're talking about replacing it. So we got to be real clear. We don't do Romanet very often at Bankers Fine Consulting, but here it comes. You quote 1026.20A. That's the section that says what's a refinance versus what is not. And I'm just going to give you a quick illustration here that if this is loan A for me and I satisfy, replace, extinguish it, and I now have loan B, that we have to give new disclosures. Now, Section 20A has some, well, you did that, but you still don't have to call it a refinancing if, and they give 5 things. What you've described doesn't meet those exceptions. Now, assuming, I'm making some assumptions here, because you're saying that you're satisfying the loan. In other words, A is replacing B, but you're changing a rate. So it isn't there is an exemption for single payment loans where, let's just say I have a 6-month loan with Jared, and at the end of 6 months, he says, can we just do this thing again? And I say, sure. What would I have given him? The same thing I gave him 6 months ago. If that's true, no new disclosures. That's 20A, and I think it's number 1 in the example. But you've got an amortizing loan, so it's not a single payment. You've got where you're raising the rate, so you can't do a new note and not give redisclosure. However, if you were extending that loan A, in other words, we're not satisfying replacing loan A with loan B. Instead, you're typing up some kind of modification that attaches to loan A. You can do almost anything you want. You can raise rates and do stuff. And if that's what you're talking about, then yep, you can extend that loan, change the rate, swap out collateral, do all sorts of things, and you don't have to give any new truth in lending disclosures. Flood, as you mentioned, yep, you're extending that loan, so you'll need to do flood again. So I hope that's clear. I'm not certain if you're replacing or extending as part of my hesitation. So let's move on, and maybe that person asks and provides some more details or something along that line. We might be able to come back and touch it again.
If the same credit report was utilized for 2 separate loans that closed on the same day, the bank would only charge the borrower for 1 credit report, flood, and or appraisal fee, as that is all the bank would be charged for. On the closing disclosure, for loan 1, Section B would reflect the fee as borrower paid at closing. Can you please explain if the closing disclosure for loan number 2 should include the same fee but listed as paid before closing by borrower, or should the fee not be disclosed at all since the borrower paid for it on the first loan?
Okay, so 2 loans, both of them subject to TRID, obviously, because we've got the appraisal, the credit report fee, or at least we're going to frame it up that way. They're closing at the same time. They're the application process all at the same time. Can we use 1 credit report for both loans? Can we use 1 appraisal for both loans? Yes. And then do we have to disclose it on both sets of disclosures? No, you would do it on one or the other because you're only going to charge them once for the credit report. You're only going to charge them once for the appraisal. And then TRID has this thing that says, and I made some notes on this, you only have to disclose it if they will have to pay or are legally obligated to pay it. They're only going to have to pay it in connection with the first of the 2 transactions, which means you don't disclose it at all in the second. Now, some of you that are listening that have been around in compliance for a while, been around in lending for a while, you'll remember back to the old RESPA rules where you would have had to disclose it twice, not in a TRID world.
Okay. Can you provide detail about the special construction statement under TRID anytime prior to 60 days before consummation? For example, are we allowed to issue a revised loan estimate 30 days before we expect the closing of the permanent phase? Generally, our borrowers inform us construction will be finished within a few weeks as they are ready to get started with permanent financing. After construction is complete, most transactions are able to close within 30 days.
All right, you bet we can handle that. So in the TRID rules, there's an item related to change circumstances that kind of gives you this free-for-all, this do-over related to new construction. Now, there's a couple of caveats that come with it. First off, just like I stated, it has to be new construction. This 60-day redisclosure statement does not work for home improvement where we've got a dwelling, we put a wing on it or put a garage on it or something like that. It's got to be there's no house and we build one from the ground up. The second piece of criteria in order to qualify is there has to be 2 phases. In other words, there has to be loan A that we do for construction. It matures, we tear it up, we replace it with loan B, the permanent phase. If you do construction to perm all in one, it doesn't apply. You can't use it there. So it's got to be 2 different phases, 2 different loans. Now, how it works, and it's a little bit deceiving for those that may not know and understand how it works, is it's the new construction statement. But the statement does not go on the construction disclosures. It goes on the permanent phase disclosures. Think of it this way. When I come in and apply and Dave's my loan officer to build this new house, this dream house of mine, and he does it in this two-phase fashion, he's going to give me two sets of disclosures today. He's going to give me a loan estimate for the construction phase, which is probably a few weeks away. He's also going to give me a loan estimate for the permanent phase, which is 6, 9, 12 months away. Well, the reason this statement, this do-over, if you will, change circumstance exists is because the disclosures he's given me today for that permanent loan that's 6, 9, 12 months away, well, the likelihood of them being real accurate isn't very good. And so they wrote into this rule this opportunity for banks to disclose today for something way out there, like the permanent financing, and then come back around when the bank believes they're about 60 days out from closing that perm loan. Now, that's a bit of a guess. We don't know based on, how construction's going. We can do some inspections, but where we think they're about 60 days out, we get to redisclose a new loan estimate for that perm phase and start over. But it requires that initial statement to be on page 3 at the bottom of the loan estimate for the permanent phase, the first one that goes out. Now, the question goes on to ask about, well, we weren't quite 60 days out. The borrower came in and they said, 30 days we're moving in. If you've got the magic builder that gets things done ahead of time, great. Don't hold up the borrower being able to move into their house because you've got to follow this 60 days. It's where you anticipate 60 days. I will say this. If you're not hitting 60 days some of the time, you need to maybe reevaluate how you're arriving at your disclosure change circumstance time for this new construction. But that's how it works.
Okay. If a customer requests cash out on an investment residential property for the purpose of constructing a residential property for resale, is this HMDA reportable? The residential property being pledged is owned free and clear.
All right. So I want to make sure I understand. We have a cash out on an investment property, meaning like a rental house, something like that. But it's to construct. So construction loans are temporary, and we're excluding them, especially if they're to builders. Is another thing that even says, I don't know if it's a builder, but there's a little bit of here. Is this a builder loan? Is this a consumer that is just doing their own construction, but for resale? I'm assuming spec house, therefore, those are exempt. Now, I also reading in here that maybe we're replacing construction with construction. I'm going to add a little more to what the question is. Anytime you have temporary financing following temporary financing, it's still temporary. If you're doing some type of temporary financing followed by perm type of thing, all in one, then you're going to have a temporary and then a purchase is what I know I'm probably reading too much into this, but so is this HMDA reportable? Not if it's a builder loan. If you're doing construction followed by perm to a consumer, then it is reportable as a purchase when you get to the permanent phase of that. So now, before you go on, Diane, we actually had some clarification on that 7-year followed by 7 years. And I had actually 2 people that are chiming in saying it is something they're doing not by replacing, but rather a modification or extension agreement. So a change in terms modification agreement, not reportable. HMDA says do not report those. And you can do anything you want under truth in lending that says that you are not satisfying, replacing, extinguishing. So you could raise the rate up, et cetera. That'd be fine.
Okay. Would you please confirm if the right to receive a copy of an appraisal disclosure in Regulation B needs to be given when a pre-qualification becomes an application and is denied?
I'm actually going to answer the question a little bit differently, but the answer is going to be there in plain sight. Now, let me put this out there. I think this is one of the stupidest requirements that we do. But in Reg B, when it comes to the appraisal requirements, that the notice, it's any application that is or will be secured by a 1 to 4 family first lien. What's that mean? We look at the definition of an application in Reg B, which is very broad. Any oral or written request for credit. If you have that, plus you believe that it is or will be secured by a 1 to 4 family dwelling, and that would include pre-qualification requests, that notice has to go out within 3 days. Now, the rest of the question, well, what if we know we're going to deny it? Unfortunately, it still has to be provided. The CFPB has chimed in on this, and so stupid as we may think it is, it's a requirement. Banks get written up for it. I advise you to do it.
I recently listened.
Go ahead. Let me catch up. We have a lot of people who are asking questions in the chat room, and let me explain that to you. If you just joined us, we explained this before, but Diane is watching. I'm watching. Jared's watching the Q&A button. And when it's something we can open up, the chat function is our administrative team. So if you have any logistical issues of sound or video, ask those questions there or make comments. But if you have questions that you want to feed to Jared and I, please put them in the Q&A room if you would. Use that button. We can't watch two places at the same time. So, Diane, go ahead.
Okay. This person recently listened to a webinar, and the presenter stated that she received information from the CFPB that if you make a loan on a house that is being converted to a commercial use property, such as a daycare, you have to look at what the structure is up to the time you close the loan, and this would be reportable. I was under the impression that you will look at what the structure will be once proceeds are applied. So this would not be reportable. Have you heard anything about this?
Oh, I've not heard anything different. I think either there was a misunderstanding or that presenter was absolutely just incorrect. In fact, again, we don't do Romanet very often, but I opened up my HMDA book. If you want, here's the citation. It's the commentary to 1003. That's HMDA. Point 2, F as in Frank, comment number 3. So point 2, F. Comment number 3 says that a home being converted to a daycare facility or professional office is not a dwelling. So I don't care what it was, it's not going to be, and I'm going to add in plain English, once the proceeds are applied. That's the example that they give, saying this is not a dwelling. It was a dwelling, it's not going to be, therefore HMDA does not apply, because you have to have a dwelling secured loan for HMDA to apply.
Okay. Can you please confirm whether or not the loan estimate term's expiration includes Saturday?
Okay, so let's give a little bit more detail here to make sure everybody is focusing on the same reg and the same disclosure. This is a TRID question. It has to do with the loan estimate. The top portion of it, right-hand side in the rate lock section, there is it locked, yes or no? And then below that, there's a paragraph. There's 2 sentences in that paragraph. The last sentence has a date, time, and time zone in it. That date, time, and time zone has to be at least 10 general business days from the date of the date of the original loan estimate being delivered. So let's go back to that paragraph. At least 10 general business days, not calendar days, business days. And I use the word general. What's that mean? Well, Truth in Lending uses 2 different definitions of business day: precise and general. General means a day on which you're open for substantially all business functions. Here's what that means for all of you listening. Do you count Saturday? Only if you're a full service bank on Saturdays. If the lobby's just open and people can come in, make deposits, take money out, maybe meet with a loan officer, get loan funds that were maybe advanced yesterday, they're picking up the check. Hey, but you're not a fully open servicing bank on Saturday, you don't count it. You have to give them another additional day when you count that 10 business days. The biggest mistake we see is counting calendar days there.
Excuse me. A HMDA applicable loan was approved to an entity. Prior to closing, the applicant requested the loan be placed in their personal name. When the loan was approved to the entity, the income from another corporation was relied on in the credit decision. Since our borrower is now an individual, is this the income we would report on the LAR?
Now, this is a little complicated. I see this as actually an application, and then it was withdrawn or maybe approved, not accepted, and a new application. Because I don't think you can have an application from Bankers Compliance Consulting that morphs into Dave Dickinson. It's 2 different people, and you're underwriting the company, and now you're underwriting the person. So the cleanest way to do this would have been to say, here's this application that we have, and it was approved to an entity. And then if we approved it fully, they decided to withdraw that. So that would be approved, not accepted. And then there's a new application, very similar, but it's from this person. And it's whatever income you relied upon in that case. So I know I don't know what to do with your question. Let me ask you this. What about demographic information? Are you going to say, no, the entity applied, but gee, Dave Dickinson's name is on the note, so we don't have demographic information? Or we do, but he was added later? There's all sorts of problems that you're creating by having this morph, if you will, instead of closing this thing out and then starting in a sense fresh. Now, I'm not saying you have to start everything over in a sense, but when it comes to HMDA, I would kill the old one and start with a new one, and then you don't have any of these questions.
We had a zero tolerance fee increase and as a result gave a tolerance cure as a lender credit in Section J, total closing costs. On our closing disclosure, Section J has the correct tolerance language, that there is an increase in closing costs above legal limits. However, the calculating cash to close table takes the lender credit into account and reflects the same amount in the loan estimate column as in the final column. It states the amounts did not change and does not include the legal limit language that Section J has. Is that correct?
All right. So some of you may have to listen to this. Remember, it's being recorded. You'll be able to download that. There was a lot of detail there. The short answer is, in theory, based on your software, this could happen. If you had a tolerance cure for a 0% item, in this case, and every other fee that would be within that section on the cash to close table, on that line, if every other fee you charged was exactly the same on the loan estimate as it was on the closing disclosure, and you do this tolerance cure to correct the one that went off, yeah, they're going to match up. And I bet your software is not going to include that the statement that things changed and that legal limits were exceeded. It's not that you are allowed to do it that way. It's just, I bet it's a software issue. Diane and I talked about this one ahead of time. You should have the legal limit language in the cash to close table, but I'm guessing that the software says, oh, they match, and it won't allow that to happen. So you might want to check into that. I don't think it's going to be something that's real common because the likelihood that every fee is the same other than the one that you were off on, probably not very, but I see how it could happen.
Okay, back to HMDA. We are financing the finishing work for the construction of a residential property. It's basically the shell of the building, and the proceeds of the loan will be just for the interior work. The loan will have draws, then will be on a 10-year payout. Should this be reported as home improvement? It is just one loan.
All right. And I have to apologize. There was a question similar to this about 6 ago that I had this one in my head because it was pre-submitted and I started to answer this one, I think, instead of the other one. So let me answer this one and I'll clarify the other one as well. So this is construction followed by construction. Now, it's also construction perm, it sounds like. So construction followed by construction is still temporary. And if that's what you did, let's just say I have construction loan A and I replace that shell to finish out the construction. I'm going to still call that construction. If that is then replaced by a permanent loan, that permanent loan would then be the purchase. Okay? If this is we already have this construction loan and we're going to do this new thing to finish it out and permanent, again, it's construction perm, and I would call that a permanent loan. Purchase, I call that permanent loan a purchase. That's what this one is about. So now you have to understand a little bit. We're sitting here reading Q&As and we have all sorts of things ahead of time, and I'm like multitasking on steroids. So I want to go back to that one. It was about someone that's doing a cash out on an investment property for the purposes of constructing a spec house for resale, it said. That is a builder loan and that is exempt. Boom, let's make that much clearer. So, all right.
Okay. Does the homeowner's insurance premium need to be listed in Section F, prepaids, on the loan estimate and closing disclosure on non-purchase transactions if due within 60 days of closing?
All right, so we've got another TRID transaction. And what I was reaching for here just a minute ago is this is the disclosure, Section F prepaids. We're not going to limit the answer here to just homeowners insurance. I'm going to put taxes in there as well. So how we've tried to explain Section F in plain English is this. Anything that is due and payable relative to those items, so taxes, homeowners insurance, that is due and payable between the application date and the first payment due date. So notice I didn't say closing. Anything that's due and payable from the application date to the first payment due date, and you're aware of that, should be disclosed on the loan estimate. Now, I'm going to give one exception. If there's something that's past due, in other words, due before the application date, and you're aware of that, and you're going to require that to be paid, that too can be included in that section, like past due taxes. But if you have knowledge that it's been paid in advance, so I lay that information down in front of you when we apply, yep, paid my homeowner's insurance for the entire year. I've paid the whole year of taxes ahead of time. Well, then you wouldn't disclose in Section F any homeowner's insurance or taxes. If you don't know then it's based on the best information available, that there very likely would be tax payments and very likely would be a homeowner's insurance payment. So it's the best information available, and it's anything due and payable from the app date and the first payment due date.
If a loan application has a place for marital status, but also contains a statement that this field is not to be filled out for an unsecured loan, however, the customer inadvertently fills it out anyway, how do we rectify this?
You don't need to rectify it. You've said, do not complete this unless, and it probably have, secured things like that. That's right in the model forms in Reg B. So the customer went ahead and went too far, if you will. Not your fault, not your problem. Just don't scratch it out. Don't worry about it.
What documentation do we need to retain to show whether or not a loan is a qualified mortgage?
All right. So when it comes to ability to pay, and I'm going to say the same thing is true for HMDA information. You want to make it extremely easy for auditors and examiners to find this information in your file, because if you just say, well, it's in there somewhere, then they have to thumb through and touch every page in your loan file, and they're going to find the things that you thought you deleted, the things that you never thought were in there, and you're going to get in trouble for those things if they shouldn't be there. So let's try to keep this simple. Get them in, get them out. You should have a section for things like HMDA information, for ability to repay, and if we're talking about a paper file, maybe it's a tab section. If we're talking about an electronic file, maybe there's a folder that includes all ability to repay information. But you have to document all of the criteria for each type of qualified mortgage, whether it's the standard, whether it's the government sponsored entity version, the small creditor version, and even non-QM loans. You have to have ability to pay information retained in the loan file. So make sure you have it all in one nice, neat place, and it's not scattered throughout the loan file.
Okay, this next one we received on loan-to-value ratios, and we assume it's for HMDA. For HMDA's loan-to-value ratio, can you take cash off of the loan amount and then divide by the remaining collateral value, or do you add the cash to the collateral value and then divide the loan amount by this combined total?
I'm a little bit confused by that. Again, we're going to assume this is HMDA, but let me just put some numbers here. I have a $100,000 loan that I want to refinance. I'd also like $20,000 cash back. So what am I requesting? $120,000. That's the debt, the loan amount divided by the value. Let's say this house is worth $200,000. It'd be $120,000 divided by 200. You don't subtract out the cash out on your loan to value ratio.
Okay, do we have a comprehensive list of HOEPA and QM fees?
I wish it was that simple. And Diane, correctly, you're going to share a link, just some additional information on this question if you go to the chat icon here in just a moment. But when it comes to HOEPA, or high cost mortgage points and fees, and qualified mortgage points and fees, they point to the same definition. And essentially it works like this. The reason I can't give you a simple answer, they list them all out and they say, all right, all of these are considered to be defined as points and fees. However, you get to go back and look at each one of them and say, all right, if this and this and this, you can pull the fee back out, and it's not a point and fee. And so you have to make this determination on your own. It's not as simple as the finance charge definition. This is more complicated. So I can't hand you a list, but I can give you some information that might help you out. This is something you should have determined for your institution long ago, and maybe reassess periodically.
And I apologize. I need to get that link. I will try to do so here before we're done. Next up, when determining the amount of needed flood insurance, when the appraised value is the lowest of the three determining factors, is it okay to deduct the land value that is included in the cost approach section of the appraisal from the final appraised value?
All right. This was a pre-submitted, and they gave a bunch of numbers that we're going to skip over because it would make it hard. But here's what I heard in that. We're talking about the lesser of three for flood insurance, and they're saying that the cost approach, or they call it the appraised value, being the lowest. So you can't insure something for more than it's worth. So it's very important here that we know exactly what this building is worth. True cost approach is what it takes to put that building back. If we're talking about appraised value, I don't know if you're talking about market or whatever. So no, we don't want to insure land. So let's just say you have an appraised value of $200,000. and assuming that that's not market value, you think that's really the cost of the building and the land, then we would subtract land out. But when you use the word cost approach, that sounds to me like, what's it take for the lumber and the shingles and the brick? Well, that is the amount that you're going to need to insure. And you would not want to subtract out land from that, or you're going to have too little for flood insurance. So for the person that asked this specific question, they tell me the cost approach is $168,000 and some change. I'm going to tell you that's what you need for flood insurance. I think based on what I understand here, do not subtract out the lot or land value.
Okay. If the customer chooses someone other than our affiliate to do their closing, but our affiliate still ends up doing the search, does the search fee go under did not shop for or did shop for on the closing disclosure?
All right. With this question, we have to make a few assumptions here to frame it up. So I'm going to go back to the question. The opening was if the customer chooses someone other than their affiliate to do the closing. So we're talking about the closing, the settlement agent fee. Well, the question is, did we give them an opportunity to shop on a shopping list, or did we just require the use of this person? Now, let's talk about that. If it's our affiliate, you can't require the use of your affiliate. So you would have had to have let them shop, and they either picked your affiliate or they didn't. Now, in this question, they chose someone other than the affiliate, so they chose somebody else to do the closing. But our affiliate still did the title search. So it depends on whether or not you included them on your list. You don't have to include your affiliate on the list. If you included your affiliate on the list, whether they picked them or not, well, I mean, so if they pick them, it's going to be potentially a 10% tolerance. But if it meets the TRID 25% affiliate definition, this is where we get way off in the weeds, it becomes a 0% tolerance. The fact that they chose someone else to do part of it and they still used your affiliate for others, the part that they used your affiliate for would still be subject to that tolerance. It would not go to an unlimited tolerance. Did I capture that correctly, Diane?
I believe so.
Lots going on with that one.
That was easy.
Yeah.
What documents need to be given to a third-party, non-borrower grantor when rescission applies?
All right, so I'm going to pledge my house so I can get my kids out of my basement, right? So they can go buy their own place. What do I get? I'm not going to be liable. I'm just pledging my collateral. Both the open and the closed-in sections of Truth in Lending have in them this definition of material disclosure. That's what you're looking for. Chapter and verse, little Romanette here. On the closed-in side, it's subsection 23A3, and then comment number 2. And it says that the material disclosures are obviously the right of rescission, notice itself, the closing disclosure. Now, then there's some if and ands and buts. So we know we have to give the closing disclosure and the right of rescission to me because I'm pledging my house. If it's a high-cost mortgage loan, then you're going to have to give the high-cost mortgage disclosures ahead of time, right? Help me out, Jared. That's the 3 days prior type of thing, right? Yep. There's also under ATR, ability to pay and qualified mortgage, that if there's a prepayment penalty, and this gets kind of weird, that you have to offer a loan without a prepayment penalty. So what I'm going to tell you, this gets kind of crazy, and it if and ands and buts and depends that you go look at subsection 23A3(2). If it's an open-end, it's a HELOC, then basically you have to give them the rescission notice, and the HELOC agreement needs to go to the grantor, right? Now, this is something Jared and I spent about a half hour talking about yesterday. What's a material disclosure? Those are it. I'm going to tell you, could you give them other things? And the answer is yes. Now, here, I actually did this in my time as a loan officer. You want to have an affidavit, because does the closing disclosure even get signed? Maybe, maybe not. Depends on your bank's procedure. How do you prove you gave me all those things? So I would type up a letter that says, you, grantor of this house, hereby acknowledge receipt of, and you would list these material disclosures. Now, if you want to add other stuff, but what is required by reg, that's it. I would type up some type of affidavit to prove that the homeowner that's granting got those things. They don't have to necessarily sign anything. We want to make sure they're not liable, right? So they're not signing loans, things like that, but they want to have some kind of proof that they got that stuff. And that's when the rescission period starts, when the loan is consummated and they got all those things. Okay?
Okay. How do we use the courier fee and the wire fee on a TRID loan? Are we to use title in front of the description?
If the courier fee or the wire fee are components of title insurance, and I think you can argue in certain cases they are, in certain cases they're standalone items. You'll have to demonstrate this very likely through your title insurance billing. But if they are deemed to be components of title, TRID is going to tell you they have to have the word title in front of them. If they are not components of title, then they are simply going to be disclosed as their standalone description, which is courier fee or whatever it is that we're talking about.
We are a small filer and have branches located both in and out of an MSA. We were previously told to report our address, city, and zip code. Did the CFPB clarify that we no longer have to report this and we can only report the state, county, and census tracts?
Yeah, with their final rule, there has been some clarification on this. Diane and I spent another half hour today talking through this, and we were trying to figure out cumulatively how many hours we have spent talking about this area. So here comes the technical answer that it's not. Well, there is a correlation about where you have your branches, of course, but it's where the collateral is at. So we're going to buy this house, secured by this house. Where is that at in connection with our branches? If it's in an MSA in which we have an office, a branch or main office, then small filers need to report state, county, and census tract. Okay? If that property is inside of one of your MSA locations, let's put it that way, okay, you do have to report state, county, and census tract. If it's outside of the MSA of anywhere you have an office, then you're exempt from all the address information requirements. Now, there's a but. However, if you're a large bank for CRA, you don't get that exemption. So you could be a small filer, but a large bank for CRA, and then you do have to report it. And I'm just going to tell you, my opinion on this gets so crazy. Is that in or out? And we're not sure. I would report all 6 all the time. That's just me. That's the book answer I gave you before. But there's all this if and ands and buts. And then we even spent time talking about, do you use the word exempt or NA and things like that. The hardest thing is the census tract. Agree? And if you're going to report that, then the other things aren't as hard. That's why my consultation to you is I just would report all 6 all the time. But you've got your answer as well. So,
what is the best way to get an insurance estimate for a loan estimate when you don't know the insurance carrier?
Well, let's start with this, just to get everybody on the same page. When it comes to TRID and things like homeowners insurance, that's one of those unlimited tolerances, but it's kind of sneaky in that you only get the unlimited tolerance if you can demonstrate that you applied good faith in estimating the amount for homeowners insurance on the loan estimate. Now, what's that mean? It means you got to do your homework. You got to put some sort of due diligence into obtaining the estimate for insurance, which is why this question is being asked. So what would that be? Well, one of the things is we could reach out to an insurance agent. It doesn't have to be the insurance agent necessarily that represents the borrower. You could reach out to the borrower. Maybe they've had a quote. Or maybe you've previously reached out to an agent and they've given you some sort of formula that says so much per thousand for homes in this area, wherever the property is located. But the idea is you can't just pull numbers out of the sky. You have to have a method to your madness. Reaching out to the agent is very likely the best choice in this area.
Diane, I'm going to bite on the time here. Look at some others. We actually had a person that wanted to follow up to a question I just answered about the cash out loan to value question. And so let me reread. They said, Becky, thank you for your clarification. Said, for the last question about subtracting the cash out of the loan amount for determining the loan to value, we're talking about cash collateral, like a DDA account that is used as security. So first off, let me do this. Are you going to really use the balance in a DDA account as collateral? Because that balance could be zero tomorrow. It's whatever's relied upon. So this is an area that there is some confusion with the CFPB. We've received different answers. So we believe it's all debts and then divided by all collateral that you relied upon. I don't care if that's stocks, bonds, cars, etc. You say DDA. If you relied upon the DDA balance, then I would include it. I'm not so sure that most loan officers, or if any, are going to use a DDA balance, though, again, because what is that balance? and it could be zero tomorrow. So that's a tough one to give you. If they use it in their analysis though, and they've got some worksheet that says today they've got 100,000 and they always maintain over 100, then I would include that. So, all right, Diane, let's go to the next question that we had.
Okay, for Hamda, if you have a loan for the purpose of future investments that is not paying off a real estate secured loan, is not to purchase a dwelling, and is not home improvement, but is secured by a deed of trust on the borrower's principal dwelling, do you code this as others, or do you fill out the fees or code them as NA since the purpose is future investment?
Yeah, I would love to have this person give me a little more information. I'm not sure what a future investment means. Are you talking about gold? Are you talking about my 401k plan? Are you talking about a house? Is it personal? Is it business? I don't know. So we need some clarification here of what you mean by that. And then is it subject to truth in lending or not? That's going to change this answer quite a bit. So I could try to get into all the derivatives and say if then, but I'd rather hear from you if you can. So please, on the Q&A section, just say, I'm the one that asked about future investments. Here's what we mean. And then second, is it consumer or business? That would help us a lot.
Where on the closing disclosure do you put an additional charge caused by a change that a customer makes after the loan estimate and closing disclosure has been sent out?
Okay, so once the closing disclosure has been provided, the loan estimate is no longer an opportunity we don't need to use that as an opportunity to redisclose anything. But the closing disclosure, once it's been provided, because in a lot of instances this is going out a week ahead of time, if something comes up that leads to a changed circumstance, and obviously that'd be something the borrower did, and that's the reason we're adding this fee to the transaction, you would simply put that fee on a revised closing disclosure in the specific section. So it could go in section A if it's an origination charge. If it could go in section B or C if it's something you let them shop for, or something you required and didn't let them have an opportunity to select, or any one of the other sections depending on the charge. So it would simply go on the revised closing disclosure in the specific area to which it pertains.
Can you touch on the private flood insurance and what you are seeing from private carriers in their policies for the compliance aid statement? Can you also cover and explain the terms they use about being a surplus lines carrier and what that means?
Yes, I can. All right, that was just funny for Gary because I know Gary asked that question. All right, Gary, so for you, private flood insurance, what we're seeing from private carriers on the compliance aid statement, we're seeing them all over the place. And I don't know exactly what you're getting here. You mentioned a shotgun effect. I would agree that there's a lot of different ways. But if you got the compliance aid statement from a compliance standpoint, you can check that box and say, I'm good to go. Your second question is, can I explain and cover the terms? Let's say, can you also cover and explain the terms they use about being a surplus line carrier and what that means? No, I can't. And I'm just saying that's an insurance industry thing. I really don't know how to touch that, or I'm not qualified to answer it, is what I'm going to say. So I'm going to say no, cannot. So
you could try calling your state insurance commission. They might be able to give you some information there.
Yeah, that might be. So, whew.
Our institution is looking at charging a flat document handling fee on all loans to cover the costs of postage and recording fees. For TRID loans, the doc handling fee will be listed in Section A. Will we still disclose the recording fees for the deed of trust and just put them as paid by the lender? If the fees happen to exceed the 10% tolerance, do we have to give them a tolerance cure even though they were never paying the fee? Or does it depend on what fee overflows the bucket?
Holy cow, lots going on there. So the first thing I'm going to say is I don't think there's anything that says that you can't do what's been presented. But let's just think about this. There's a section on the TRID disclosure for recording fees, and you're going to say, you know what, instead of trying to get that right every time, we're just going to lump it with some other stuff and call it a document whatever fee. Okay, in theory, you could do that. But let's just take Diane, Dave, and I. If we come in at any given amount of time and we each apply for a loan and there's recording fees, the likelihood that each of our recording fees being exactly the same, probably not very likely. Generally, one's recording fees is different than the others. Now, maybe they're the same in your neck of the woods, but let's assume that they're all different. That means some of the time you're making more on a transaction than you are at other times, and that brings to the table some inconsistency, and you have to ask the question is that fair? So it's not really even a TRID thing, is that fair? Is it unfair? Is it deceptive? Is it abusive? Does it fall in that camp? And I hate to throw that card down, but not if examiners come in and they don't see recording fees, and it's something we typically see elsewhere, that's a red flag that gets them to start asking questions. So I think you could do it. It's not what I'd recommend. If you did it, you wouldn't disclose both the doc fee that you're lumping together and the recording fees both. It would be a double hit. You would disclose one or the other.
Are charges that traditionally fall into the 10% bucket still included in that bucket if they are lender paid?
And what we mean by lender paid is on page 2 of the closing disclosure, the paid by others column. There's something in the paid by others column. It does not land in the 10% bucket. It would cause chaos if we did that.
Okay, we have received a couple more follow-ups.
Yep.
This one, what if, back to the appraisal notice on a pre-qualification request, what if the pre-qualification request does not specify an address or property in regards to the appraisal notice?
Okay. Property address is a HMDA thing. You won't find anything in Regulation B that says a property has to be identified. So we go back to the appraisal notice is triggered by any application, oral or written request that is or will be secured by a 1 to 4 family dwelling. It does not say anything about having identified a specific property.
Diane, let me take the one from Becky that talks about future investment. I asked for the clarification on this. So thanks, Becky. She's saying, so the question was originally, I lost the question now. Here we go. If you have a loan for the purpose of future investment, not paying off any loans, not a refinance, not to purchase, not improvement, secured by deed of trust on their principal dwelling, what is this thing? And Becky has clarified it is to purchase a home in the future or build. So I believe that you're saying we know that this is going to be used to build or purchase a house, and it's secured by a dwelling. Therefore, it is a purchased loan. I don't think you can say, well, we don't know for sure. It's what do you know? I like to say, HMDA is an application regulation. What are you going on right now? We're setting up a loan right now so that they can quickly purchase something tomorrow. We don't know exactly when that'll be, and so therefore, I would treat that as a purchase.
Okay. Follow-up question to the one where we addressed modification, and it's asking, so if we do the modification, does it have to be done prior to maturity?
All right, this is a legal question that we get all the time that I'm going to tell you, I don't know how you can extend, renew, modify a loan after it's done, and yet I see it all the time. I do know that in the industry, we have people that do that, but that contract is null and void, or if you will, when it hits maturity. I shouldn't say null and void. I'm not sure that's technically right, but it's done. How can you modify what I'm going to call a dead agreement? And so you really need to be doing extensions. Now, when it comes to the open inside, there's some pretty clear language that talks about this, much more clear than on the closed inside. But I believe that you just cannot extend, renew, modify anything after its loan's matured, after its contract date is up. So you would need to start over. I see people that do it all the time. I'm going to be honest with you. I don't want to say the sky is falling. I don't see people get in trouble for this, but I do think that you're playing with fire.
Can you clarify what seller charges must appear on the borrower's closing disclosure?
Okay, that's a bit of a can of worms, but we'll do our best here. So on page 2 of the closing disclosure, anything related to the seller payable in connection with the transaction has to be disclosed. The example given over and over and over again is things like real estate commissions paid for by the seller. You might think, what business of the borrowers is what the seller pays for commissions to the realtor? Frankly, I don't know what business it is either, but there's nothing in TRID that says you, the lender, can leave anything off of page 2 of the closing disclosure, even if it's a seller fee paid by the seller. Now, on page 3 of the closing disclosure, on the right-hand side, the seller side of the transaction, you can omit all seller information from the borrower's version of the disclosure. But on page 2, everything has to be disclosed.
We have made a commercial loan secured by a rental property, but the loan approval does not provide any income. What should I use for income when I report this loan for HMDA?
Well, if you don't have any income you're relying upon, you would not report. It's NA, I believe, is what it is. Now, is this an entity as well? There's an exemption for income to entities, but if it's an individual, did I hear Diane you say they're not relying upon income?
Yeah, at least they don't have it documented. So.
Yeah, then you report NA, not relied upon.
Okay. On a multiple advance home improvement loan, should funds to the borrower be shown in disbursements to others rather than to the borrower?
So TRID is the context of this question. And so I'm actually going to really simplify this. Whether it's construction or home improvement doesn't matter, or any other type of multiple advance closed-end loan. Any multiple advance closed-end loan gets completed essentially the same way when it relates to those funds that have yet to be advanced. So you're going to complete it just like the instructions in TRID do for a construction loan. There's a singular way to do it. You're going to disclose them on page 3, and you're going to do it in section K, or you're going to do it on page 3 in the non-seller version, the alternate form. You're going to do it on page 3 in the payoffs and payments section. That's where you'll disclose what has yet to be advanced.
If someone is just paying off another individual for the purchase of a home and not technically satisfying and retiring a debt, would this be a purchase for HMDA? With the loan proceeds, the borrower is also paying back his parents for some home improvements. Would this be a purchase, refinance, or home improvement?
I'm going to call that other. So this funds is not used to purchase with the title transfer. I already have the house. It's not used to refinance an existing loan. It's not used to improve. Now, they said the prior loan was for the parents, but this is other. Jared?
Yeah, sorry, I was reading one of the questions. I didn't catch that.
Never mind. Just say yes, Dave. Of course.
You're right, man.
That's right.
Is there an update to TRID that changed collecting seller's information for the closing disclosure?
Not that I'm aware of. That answer that I gave just a couple seconds ago, that's been the answer from day one. And the CFPB and a couple of the different of their webinars that have come out since TRID went into play, they've addressed this over and over again. And banks are getting written up for it over and over again by consultants like us that come in and do reviews as well as examiners. So you've got to make sure you're disclosing all that. It's not something that's new.
Is TRID applicable to an application from an LLC to purchase a primary residence which is underwritten based on personal income?
Okay, so we got to go back to truth in lending, definition of a consumer. It's got to be a natural person like you, I, Dave. And so if we've got a loan that's being made to an LLC, truth in lending wouldn't apply, TRID wouldn't come to the table. Now let me do this. There's an exception. The exception would be some types of trusts, and I'll leave it at that.
If you issue a loan estimate prior to receiving the purchase agreement and don't disclose any optional inspections and then receive the purchase agreement and those inspections are shown, should you issue an updated loan estimate?
Well, those are voluntary items. Now, it comes with this caveat. If you knew about those voluntary inspections because the borrower laid them on you before they signed the purchase agreement, then I would argue they should have been on the loan estimate even though you didn't have a purchase agreement. But if you truly didn't know about them until you got the purchase agreement and they're truly voluntary, you wouldn't be required to issue a new loan estimate just because you have a purchase agreement that has some voluntary charges on it. Now, if you encounter an additional change circumstance down the road that is something that you want to reset a tolerance baseline on, then you would have to update that information that you had since the last loan estimate went out. That's that principle that is TRID 2.0 that says every time you give a new piece of paper, everything on that new piece of paper is the most accurate it can be when it goes out the door.
Okay. We have a couple of follow-ups to the appraisal notice again. Someone's asking, did you say that we have to send out the appraisal notice even if the loan is denied within 3 business days of application?
Yes, I did. You heard me correctly. Like I said, it's a stupid requirement, but you're technically required to do it. I know, I get it. Dave, you've applied. You know what? We're not going to do the loan. But here's an appraisal that says that if we order one, which we're not, that we'll give you a free copy.
I'd like a copy of that then.
Yeah, sorry.
But we didn't do one. Yeah.
I know. You heard me right.
Okay, along those same lines, can that appraisal notice be provided electronically without triggering e-sign?
Okay, let me do this. If you deliver that disclosure electronically, the general rule is it requires to be provided and follow e-sign consent, which you'll have to make sure that you go and get familiar with. There's one exception. If you provide an online application form and you include the appraisal notice, that online application form that includes the appraisal notice is not subject to e-sign. It's the lone exception. If I want to email you that appraisal notice, it has to be done through the e-sign compliant channels.
Okay, someone's saying, we currently list our flood certificate fee and inspection fee in Section A, origination charges, but their regulator told us that they should be in Section B, that the borrower did not shop for. However, when added to Section B, they don't go into the APR calculation. Is that okay?
Oh, this is a fun one. So the flood determination, okay, my guess is you're not doing your own flood determination. Most banks don't. There's a lot of liability in it, and there's a lot of companies that'll do it for you. So if it's a third-party service required by the lender and you don't let them pick the provider, that's a Section B charge, which most flood determinations are. Now, why are you putting it in A? I heard, Diane, that you said they're putting it in A so that they can make sure it affects the finance charge correctly, because I'm assuming it's life of loan. Well, remember this, don't try to use TRID disclosures to do Truth in Lending Act, finance charge, descriptions, calculations, etc. It's two different requirements. If you manipulate TRID to do finance charges correctly, TRID's going to be wrong. If you manipulate finance charges to do TRID correctly, your finance charges are going to be wrong. They got to be siloed within your loan origination system typically. Don't use one to drive the other. You'll make a mistake.
If a single applicant accidentally signs the top joint intent portion of the 1003 application, should we cross that signature out or just leave it?
Okay. Most of the time, there's three things. It says, how are you applying? Individually, joint, relying on your own, or joint, relying on somebody else. So I'm going to assume here that you're saying this single applicant signed that they were applying jointly. That's why the confusion. I wouldn't cross it out. I would get some type of clarification that said, okay, Diane, I see that you were applying individually, but you marked up here you're applying jointly. If that's the case, help us understand. If Diane marked down that she's applying individually and applied individually, obviously that'd be fine. So I assume it's the other that you're saying that there seems to be a mix-up. So I would just get clarification from them. I would not cross it out, and then I would write, notes to say here's what they meant or whatever. But I wouldn't touch their application. They filled it out.
All right, team. Well, I have that we are at the top of the hour. What I'd like to do is, first off, thank you, Dave. Thank you, Diane. We've got through a ton of questions in that 1 hour time frame. I tell you what, it flew by. If you're looking at the screen, what I have up there is we have our next forum ready to rock and roll. It's going to be on April 28th, and we're going to just simply shift from lending questions to your deposit questions. That link's out there. You can go to our store. You can get registered for that today. It's free, just like today's version. So if the lending people are here today, please pass this information on to the deposit folks at your institution. Now, the other thing I want to do is, again, thank everybody for coming by today and being part of this compliance forum. Couple of things before everybody closes out. There is a survey that should have popped up behind the scenes. We would love to get some feedback from you on our compliance forum today, the lending Q&A. Just take a couple moments, give us some feedback. We're always striving to go from good to great, just like you are, and that little bit of feedback helps us do that. Other than that, Dave, do you have any closing comments? I
want to say thanks to you. That's incredible, and thanks to Diane. It's difficult to be thinking through and watching all those things, so well done, team. And thanks to you.
Well, hopefully you got some plain English solutions to some of your compliance questions today. With that, we're going to let you get back to what it is that you do best. That's serving your customers. We'll see you next time.
Thanks.